Sure. I mean, just to give you a background, I started off my career in banking, spent about for 13, 14 years across various aspects of banking before I even started thinking about setting something of my own. And I think the foundation of why we started FinEdge stemmed from that experience. I did see certain gaps, but I think if you, even today, if you relate, I'm talking about 10, 12 years back when we started FinEdge, but even today, Kalpana, if you just think about wealth management, the first thought comes to mind is HNIs who have made money, who are now trying to increase or get greater returns or to safeguard that. And that is pretty much the definition of wealth management. Even 12 years back, this was a lot more, right? So wealth management was only accessible to 0.5% of the population, people who had already made their money and they were looking at engaging professionals to manage that money. Um, I saw this huge gap. Everybody was running after this 0.5% of the population, and nobody was really interested in reaching out to people who wanted to create wealth, who did not have it today. And that is 99.5% of the population. So of course there were lots of gaps within the HNI wealth management space, which a lot have been addressed today or people are trying to address. But we were always very interested in reaching out to the unserved, the vacuum which was there, that nobody was reaching out or helping people who didn't have the money but had the aspirations and to do well in the future, wanted to create funds for their goals, but there was no help for them. So I think we were inspired by this vacuum. We said, there's a huge potential. These are people who needed the most. We came from very middle class families, and we saw the struggle that our parents went through in educating us and all of that. And so that's where our heart was as well. So I think this is where was the initial thought process of starting FinEd. But when we started FinEd, we identified four core problems that we wanted to address. I think the first one, like I've said, is the advice gap. Huge majority of the country had no access to financial advice or quality financial advice. People like you and me, when we 10, 12 years back, when we reached out and wanted to start investing, most likely the person who would engage with us would be an insurance agent who would sell a product to us which might not be the best for us. So the wealth creation was happening for the seller, but not for the buyer. Outside of that, there was nobody else. So this is the one problem that we wanted to solve. We wanted to make quality financial advice accessible to everybody. The second was when we spoke about the fact that we want to reach out to retail investors. The biggest problem is in our industry, most of the financial decisions are led by emotions. So you need a human expertise, you need a relationship to truly understand the requirements of that person. So the second problem that we wanted to address was people who said that if you try to scale, then you have to let go of relationships. And we didn't want to do that. So this paradox which existed between relationships and scale is something that we wanted to address in our business model. The third was, like I said, recommendation traps. Even today, unfortunately, that still exists to a large extent in the country. When people approach me for investments, the first thing they tell me is, tell me a good stock, tell me a good financial tip, tell me where to invest. Not realizing that in creating wealth, the most important decision is not where to invest or which stock to invest in, but to have a proper plan in place, to have a process in place. So unfortunately, we buy into a sales trap by first asking for recommendations. So that was the third problem we wanted to solve, where we wanted a fantastic investing process to be in place before we decided on the products that we wanted to offer to people. So people before products is what the motto was. And the last bit was that this entire thing about greed and fear. So people, behavior management. People think if I quickly trade and try and double my money in 1 year, that is the right way of approaching investing. Whereas I think the biggest difficulty, even somebody like me who's been in the industry for 25 years, one of the biggest difficulty is not doing anything to remain invested, because the compounding which happens over a period of time is phenomenal. That is the true wealth creation which happens. But the urge to do something, to trade, is what kills all of this. So we wanted to address the behavior management aspect of investing. So these are the four key things that we set up FinEdge for. To a large extent, like I think every business model in India today, there are lots of challenges, right? I think we are still a nascent country which has just got into a lot of open. So, especially financial services, if you look at it, one of the biggest challenges is that while you're constantly trying to innovate and bring technology in, there are two aspects specifically within the financial industry. One, pure technology cannot solve all problems because every financial decision, whether we like it or not, technology can give recommendations, can assist. But like I said earlier, when we are taking a financial decision, it is usually a very emotional decision. Now, for example, when I say I want to invest for my daughter's wedding, I mean, it is hugely emotional. We are not like the Western world, which is very cut and dry, right? So we have a family and we have responsibilities. So a lot of these decisions are not as simple. So you really, even though technology can quickly make a four recommendations and tell you to invest, but going through the journey of selection, understanding the requirements, you need people. So I think one is this in our industry specifically. For example, if it was e-commerce, it's not necessarily an emotional decision. You like a product and you buy it, that is how simple. If you have the money, you'll buy it. But over here, since that is there, so you have to somehow think of a solution where you have human expertise, where you have behavior management, and you have technology at the play. The second, I think, even bigger challenge is because you're operating within a certain framework. And now, unlike other industries where regulation obviously is very different, in our industry, it can become very restrictive simply because you have to safeguard the people. Well, once again, when you're dealing in financial services, the ability for people to misuse that or cause damage to people is very high. So regulation will always be very tough. So it's this constant fight between innovation, technology, human expertise, and regulation that you have to somehow manage all of that and still adapt and bring about changes and add value and evolve as a company. And that at a macro level, I'm saying, but at a micro level on a daily basis, that does lead to enormous challenges. So I think what we have is a purely 100% digital platform. So the only difference is it's not a pure DIY, do-it-yourself platform. It's not a robo-advisory platform. So what we call the investment platform as dreams into action. So putting our dreams into action and start planning for them. And I think over here, when a person comes on board and asks, I think the key over here, to a large extent, we have people who assist them pre-investing. So that means to understanding what are your goals, what do you want to invest for, understanding your cash flows, making a monthly budget, under seeing what kind of outflows, inflows that you have, understanding some certain very critical aspects about personal finance. For example, what is your debt ratio, your leverage, how much loans do you have versus your salary, how much savings do you have versus your income. So getting these basics in place. Post that, the understanding is what is the reason that you want to invest, what are your investing beliefs. One of the biggest constraints of people not being able to invest long term is that you start off with wrong expectation. Today we are seeing people go on to tech platforms, transaction platforms, and they say, oh, so and so fund gave XYZ 50% return. I am going to invest in that fund because in the next 12 months I will get 50% return. I mean, your expectations cannot be any worse than that. And it is pretty much guaranteed to give you a bad experience because the equity markets don't work in that way. In fact, most likely, the fund which has outperformed in the last 1 year has a fairly large probability of underperforming in the future. So it's one of the worst ways of investing. So your investing beliefs is to attempt to set these expectations right so that you have a great experience. So you have a grounded expectation. And post that, of course, understanding your goals, doing calculations on inflation and doing calculations on compounding and doing the maths around getting your number absolutely right, customized to your requirement. Only post that comes the stage where technology again on our platform will give a recommendation based on your beliefs, based on your cash flows, based on your age, based on your goals, in terms of what is the right product for you. Sometimes the right product could be that you should not invest in equity markets. So for us, we want to be client centric. We don't want we pride ourselves in the fact that we are not a sales centric company. We have no intention of trying to position product. In fact, FinEdge is the only company that I know of within our industry which has no product targets, no revenue targets, no target to sell something. And the idea is give the right information, which is customized to the person, follow a very strong investment process, let it be all digital and let it be all tech enabled, but at the same time, have a human expert who will assist you in all of this digitally. We restrict ourselves to products which are suitable for clients and their goals. So when typically, if you ask me, what do I want to do? A person might have 5 or 6 goals. It could be prepayment of a home loan. It could be emergency fund. It could be retirement, children's education, marriage, etc. These are all long-term goals, and we are talking about a set of clients who want to create a corpus. So they don't have the money. So real estate and all, we've not gotten into. We don't do stocks. We don't do real estate. We don't do any complicated products. We don't do any insurance product. We strongly believe insurance and investment should not be mixed. Now, after that, what is right for a client? A product which is well regulated, low cost, professionally managed, is transparent in nature, keeps the money of the investor safe. And there is only one product in the country which is like that, and that is mutual funds. So 99.9%, the solution to most of the goals that a person that we deal with is mutual funds. There are a lot of people don't know, but about 3,500 mutual fund schemes. There are debt schemes, equity schemes. So you can pretty much, according to me, up to a wealth of about 500 crores of an individual, you don't require anything else outside of mutual funds, subject to the fact that your expectations are right. You are investing systematically. That means risk is being taken care of. And then your ability to remain invested over the long term. Because once again, for people that we help investing, one of the biggest challenge is to beat inflation. Inflation is extremely one of the key reasons why, a lot of people sometimes what we call is not taking informed risk. When I put money into a FD or into an insurance product, I'm getting 6% post tax or maybe even less. Today, real inflation, you can't go by WPI, CPI. Education inflation is inflating at 11%. Your investments are increasing at 6%. There's a 5% gap right here. I mean, so these are important things. Like I said, when you're doing wealth management, to a large extent, asset allocation, real estate, all of that, when somebody's already made their money and now that person has 100 crores and he comes to you and says, I want asset allocation to happen, that's where all of these multiple products come into play for risk reduction. But when you're talking about wealth creation, your biggest challenge is to ensure that you beat inflation, and the product has to be professionally managed, transparent, regulated, low cost, and there is no other product.
So far.
So I think the biggest mitigation of risk is in two ways. You're absolutely right. Whenever you invest in any equity or equity related product, there'll always be market risk. There can be no assurance. There are no guarantees. I think the only way that you can reduce risk when you're investing in equity is through two ways. One is to invest in a systematic and a disciplined fashion that basically by investing regularly at systematic intervals, you reduce risk because you're doing a rupee cost averaging in that case. That brings down volatility. And the second reason is to remain invested for a longer duration. Now, studies will show you that if anybody who does a SIP over 7 years will never lose money, over 10 years will never lose money historically. Now, in that case, these are only two mitigations that you can possibly do. So again, your question is absolutely right. On one side, I have to take informed risk. On the second side, I have products where I don't have to take risk, but I cannot beat inflation. Now, this is a choice that you have to take. Sometimes some people, even after this choice, what is right for them could be a risk-free product because mentally they are not prepared to take risk. They should not get into any equity product. And that's where, understanding expectations, understanding investing beliefs comes into the picture. So the answer to everybody's problem is not equity, despite the fact that on paper or through theoretical knowledge, I can say, yes, mutual funds or equity is the great product. But mentally for that person, it might not be the best product. So you're right. And in the end, there is no answer. There are no guarantees in equity when you're investing in equity. There is inherent risk when you invest in equity. But there are ways to manage that. One is by setting the right expectations. Second is investing systematically. And third, making sure you remain invested over a long period of time. So I think specific to your question, there are two or three. As when it comes to investing, I think we did see an increase in taxes on your long-term capital gains, short-term capital gains, as well as people who do speculative trading in futures and options. I think the future and options specifically has become a cause of concern for regulators simply because they were always a hedging tool for institutions. Now, what has happened has become a fad these days, and almost every young investor is starting off in derivatives. There are many reports which have got published where huge losses are happening to retail, but it's an addiction. It's like gambling, and I think the regulator and the government together want to restrict futures and options, which is why we've seen a drastic increase in STT on the futures and option side. Having said that, taxes is something like we say, death and taxes are a certainty. And the more participants happen, the more the government will tax that product. Once again, I think the importance of long-term investing comes into play because your long-term capital gains has only gone up by from 10% to 12.5%. So that's one part. So no great phenomenal news from the budget, nothing really negative, nothing really positive, nothing much has changed. On the personal taxation bit, a little bit incremental tax-free income for people if you take the new regime. I think 17 odd thousand rupees is what you can possibly save at the lower end of the new tax regime. So these are two significant changes. As far as the ecosystem is concerned, to a large extent, we have seen a lot of funding happening in the financial tech yeah, space. I think over there, abolition of the angel tax is an advantage for more people to come in and start investing into companies. That we should lead to a lot more startups happening. That should lead to a lot more job creation happening. And on the last bit, I think as a whole, as a country, I think we've reduced tax on foreign companies setting up shop in India from 40 to 35%. So once again, that should not specifically the financial ecosystem, but as a whole, that should get new entrants coming into the country and setting up a permanent establishment. Again, I think one big mistake that we've seen people make in the past is that they come into the financial services industry with the same sort of innovation aggressiveness that they have seen in other industries, and that doesn't work because the regulation is very, very tough over here. So, to some extent, yes, anybody who enters the financial services landscape has to finally balance innovation, tech, human, and regulation together. So I think that will, we are still very nascent to a large extent. We are also seeing a lot of evolution happening on the AI bit and data science bit. I think that will accelerate. We will have a lot more informed decision making happening through the use of data. I think that will become more and more important as we go along. Even as a company, we started off 10, 12 years back. We've seen so much of change. We were lucky to start off a little before everybody else, but we've seen the entire tailwinds happening around digital and tech space and all of that. And I think that will continue to play a very important role today. We single office based out of Gurgaon. We have clients in 90 countries, 1,700 cities. We are digital. We have a bionic model. We have a lot of data science which is running currently. We are building upon that. Who would have thought all of this 10 years back? So very difficult to answer your question because it's very difficult to peer into the future and forecast. But I know that the last 10 years, when we look back over the next 5 years, we will perhaps really accelerate in terms of innovation. But like I said, it'll always be a little constraint thought through because the financial industry has a lot of risks. Two things. One, I strongly believe that, I mean, if you're thinking about innovation and better country with the kind of demographics that we have, the kind of opportunities that are there within tech and overall, whether you're B2B or B2C. So, we unfortunately are already fully deployed. But when I look around and talk to people, the amount of opportunity everywhere, and this is at the pace that change is happening is just phenomenal. So it really makes you feel very, very positive about what the country should look like 5 or 10 years down the line. And for individuals who are watching, I truly believe, India is awakening to aspirations. And unfortunately, when you as a there's a mass awakening towards aspirations, especially we've seen over COVID, people feel that I have very little time to quickly get to what I want, which has led to a huge increase in greed. So we've seen people really trying to overdo stuff and trying to really quickly try to double money. And all I can say is that it doesn't work like that. You'll end up losing money. There are all, you have to apply logic, you have to apply a process, you have to give it time. Wealth creation cannot happen overnight, it takes time. So that's something that you have to be very careful with if you're an individual investor. Don't get carried away. Nothing is going to happen in 1 or 2 weeks or months. Something will take time, and you have to allow yourself that time.
For more updates from CXO TV, please like and subscribe to our channel.